In the world of investing, there are numbers that seem so high they almost feel like a mistake. When you see an investment advertising a return that appears too good to be true, it's essential to ask what is really going on. Today, we are going to explore that very question by dissecting the paradox of ultra-high-yield exchange-traded funds.
Recently, a new class of exchange-traded funds has come onto the scene, advertising staggering annual yields of 30%, 40%, or in some cases even 50%. For many investors, these figures seem to represent the promise of a truly life-changing income stream. And while this sounds incredibly alluring, this promise of high income conceals a fundamental, inescapable paradox. You see, the very mechanism that generates these spectacular yields is structured in a way that can, over time, lead to the systematic destruction of an investor's capital. So, how exactly do these funds produce such incredible numbers? It is certainly not magic. It is a methodical financial strategy, but it is one that comes with very significant and often hidden consequences. The entire strategy is built upon a financial instrument known as a call option. Put simply, this is a contract that gives someone the right to purchase an asset from you at a set price. Understanding how this tool works is the absolute key to revealing how this impressive income is generated. The process itself is quite systematic. First, the fund holds a portfolio of assets, often ones that are known to be volatile. Then, it consistently sells call options against those holdings. For selling this right, the fund receives an immediate cash payment, which is called a premium. And it's this premium income that is then distributed to shareholders as that high-yield dividend. This is where we find the critical trade-off at the heart of the strategy. In exchange for that immediate cash premium, the fund is essentially agreeing to sell off its best assets just as they begin to perform well. This action places a hard ceiling on its own potential for growth. This fundamental trade-off creates a mathematical problem that these funds simply cannot overcome in the long run. It is a problem that is rooted in the very definition of an investment's total return. For any investment to be considered successful, its total return has to be positive. This return is always composed of two parts: the change in the value of its underlying holdings, its net asset value or NAV, plus the cash yield that it distributes to you. This brings us to the central, unavoidable question. To just break even on its total return, a fund that is distributing a 30% yield would need its net asset value to grow by that same 30%. Yet, as we've just discussed, its core strategy is designed to give away its best potential gains. This inherent conflict leads to two very likely scenarios over time. As we are about to see, both of these outcomes clearly demonstrate how the fund's structure is predisposed to eroding your capital. Let us carefully consider both scenarios. First, imagine the underlying asset performs exceptionally well. Because the fund sold call options, it is forced to sell its shares just as they become truly profitable. It completely misses out on the major gains, and its net asset value stagnates. Now, let's consider the opposite. What if the asset's value declines? The fund still pays out that large dividend, but since there are no profits to fund it, the money has to come directly from its existing holdings. It is, in essence, just returning your own money to you, and in this case, the NAV plummets. When we put all of these pieces together, the analysis leads us to a very clear conclusion about what these financial products truly represent. These are not long-term investments designed for building wealth. They are, in fact, short-term trading vehicles, specifically designed to profit from a very unlikely condition, a market that is essentially flat. They can only work in a narrow, sweet spot, where an asset's value doesn't go up too much or down too much, a condition that is rarely sustainable. This statement perfectly summarizes the dynamic at play. The incredible income that these funds provide is not a new return that's being generated by the market. Instead, it is a direct conversion of your own potential for capital growth, or worse, your original principal investment, into an immediate cash payment. So, what are the key lessons we can take away from this analysis? They're quite straightforward. You must always look beyond the advertised yield. Your focus should be on the total return, because an exceptionally high yield is often a warning sign. It signals a serious risk of NAV decay and the potential erosion of your original capital.
Ultimately, this leaves every investor with a critical question they must consider for themselves. Is the powerful allure of immediate high income worth the significant long-term risk to your principal investment?
If you found this breakdown of complex market mechanics valuable, we invite you to follow Finbot Insights for more financial explainers just like this one. Please be sure to like this video and subscribe to our channel to see our next analysis.